Macroeconomic data may help to set the tone in the coming week, in the form of multiple sets of jobs data in the USA, the latest beige book from the Federal Reserve, and an interest rate decision on the 5th of June from the European Central Bank, which is expected to cut once more and also lay the groundwork for further reductions in the headline cost of borrowing in the second half of the year. We've also got a few sets of domestic company results to study, notably Sirius Real Estate on Monday the 2nd of June, Kemmering and Gooch and Housego on the 3rd, Ramsden's on the 4th, Mighty, Wizz Air, Workspace, Doc Martens and Young's on the 5th, with Caffin's rounding the week on the 6th of June. But 3 other companies may write a few headlines in the coming week for a range of different reasons, and they're British American Tobacco, Pennon, and finally Paragon Banking. Now, British American Tobacco, or BAT, is set to release a first half trading update on Tuesday the 3rd, ahead of the release of its actual interim results on the 31st of July. The shares stand near 2-year highs, as they put behind them 2023's sudden departure of its boss, a hasty withdrawal from Russia, and a £27 billion write-down of its American assets, as well as 2024's $8 billion regulatory fine in Canada. Investors seem to be looking at how the company continues to generate copious cash flow, sell expensive Indian shareholdings to buy back its own stock on lower valuations, and continue to grow its dividend. None of this is likely to appeal to investors who still run strict environmental, social and governance screens, or ESG screens, all the same, even if BAT's medium-term goal is to generate £50 billion in free cash flow between 2024 and 2030, and that's about 70% of its current stock market capitalisation. The update from Chief Executive today in Morocco won't feature a comprehensive profit and loss account, cash flow and balance sheet, and probably will therefore be judged relative to the guidance provided alongside the full year results back in February that was then reaffirmed at April's annual general meeting. For the year, BAT has steered analysts to expect 1% revenue growth, adjusted operating profit growth of between 1.5% and 2.5%, excluding Canada, with new excise duties in Australia and Bangladesh and currency movements both headwinds. Current consensus, by the way, is for £11.6 billion against £11.4 billion last year. And all of this comes with a second half weighting. Now, new categories such as vapour, heating, tobacco, heating products and oral pouches will also be an area of focus. Consensus estimates looking for a 13% increase in annual sales here to £3.9 billion, with a reduction in the losses again for the full year. Right now, all of that lot translates into a consensus adjusted earnings per share forecast of 352 pence, down from 362.5 a year ago, or 341p excluding Canada. Now, Canada could weigh on the statutory reported figure, which is seen reaching 332 pence for 2025 overall. BAT is paying out quarterly dividends of 60.06 pence each quarter this year, and is also running a £900 million share buyback. That equates to a dividend yield of just over 7% and a total cash yield of more than 8.5% once you add in the buyback. Now, another company that may be in the headlines for its yield is water utility Pennon. The FTSE 250 index member releases full year results on Tuesday the 3rd of June. Amid public fury over water leaks and sewage emissions, worries over what the AMP8 regulatory cycle for 2025-30 from Ofwat may mean, and perhaps some indigestion after last year's £1.3 billion capital raising that included January's £490 million rights issue, the shares hit a 16-year low in March. Now, they've since rallied, helped by March's analyst meeting and the prospect of lower interest rates, even if management did trim earnings forecasts for the year to March 2025. Given that, now the details of the AMP8 regulatory determination on pricing and investment are now known, attention's more likely to focus on any guidance for the year to March 2026. The Pennon's not really in the habit of giving too precise a steer. In terms of the headlines for the year just ended, pre-tax profits expected to reach £152 million, down from £166 million, before a big rebound to £360 million in the year just begun. CapEx is thought to have jumped to £643 million from £598 million, and analysts think it will peak at £673 million in the year just coming. And the dividend is likely to be rebased after the rights issue, and analysts expect 27.4 pence a share, down from 44.4, ahead of a modest increase to 27.9p in the year to March 26. Finally, we come to specialist lender Paragon Banking, which will release first half results for the 6 months to March on Wednesday the 4th. Its shares are trading at levels last seen in 2007, just before the financial crisis started to hit home, and any comments from the specialist buy-to-let and commercial lender about the UK economy could be interesting. Watch out for the usual trends to note at banks: loan and deposit growth, cost to income ratio, net interest margin, and loan impairments, as well as any repetition or adjustment of the full year guidance that was handed out and then again added to at January's trading update. Namely, new business volumes of around £1.7 billion in buy-to-let and £1.3 billion in commercial lending at the midpoint of the range. Operating expenses of £185 million, net interest margin of around 3%, and an underlying tangible return on equity of 15 to 20%. Any comments on the legal and regulatory filings in the car financing market should be noteworthy, even if Paragon does have limited exposure here. The bank's running a £50 million share buyback, and last year paid an interim dividend of 13.2p a share. First half pre-tax profit last year, as a benchmark, came to £111 million. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.